Hey, good evening, everyone. I appreciate everyone joining me for tonight's Tbill question and answer session. I did one yesterday. I did not record it, and I've had quite a bit of demand to record it. So I'm going to be recording it, and please feel free to take your mic off and ask questions, or just punch a question into the chat room. We're going to go into things. Can you see the screen? I want to go into the Discord. I assume someone can see the screen. I want to go into the Discord and show you in our fixed income section at the very bottom. In the Discord, we have this fixed income section with treasuries, bonds, strategies, and I-bonds. There are some good things pinned in the treasury section and the strategy section. And that's a great place to check out a lot of what I'll be talking about tonight. So I have all kinds of things in here. I have my second Tbill video. If you have not watched this one, it's a great deeper dive. Here's my original one. So take your pick there. I have some of these pages that I have tonight that you'll see are also in here, upcoming auctions and past auctions at treasurydirect.gov. The Treasury yield curve page, you're about to see these in the seminar. And all kind of little thoughts and tidbits that I've put in here. There's some good commentary by everyone, and there's not a ton of it here, so feel free to glance through there in the strategies. And the Treasury section is kind of the same thing. A lot of people have come in, they're not aware these things are there, so they are there. So as far as your Tbill stuff, there's some great commentary in here. Take a peek. Also in my room, for the people that are brand new, I have some thoughts here in the Nerd Niche channels. I have some things pinned in my room on treasuries. I have a little high new members thing. Check out the pins at the top of each room. Every room has pins. This is a pin. If you click on it, it brings up this window, and you can go in and consume whatever content we have placed there. Some rooms have a lot, some don't have too much. So feel free to go check all that out. And it's a really good place to learn about tonight's topic, which is treasury bills. So go to the Discord for a lot of those resources. I'm going to go in now and just do, does anyone have any questions on that as far as the Discord maneuvering around in it? Okay. I'm going to go in just briefly on what is a Tbill. A Tbill is an obligation of the U.S. government. They're short-term by definition. They're 52 weeks or less. And I'm blowing right through this. So anyone that has more interest, please go to those sites that I've referenced. Here you can go to Investopedia and just type in, what is a Tbill? And it'll bring this up. So it's a direct obligation of the U.S. government. The government directly guarantees it. Things like FDIC insurance, SIPC insurance, other things like that are directly backed by the government, but they're not the government's direct obligation. So they guarantee it, but these are direct obligations of the U.S. government. Some people have asked why Tbills. Tbills give us tremendous margin relief in our margin accounts. So if you are trading largely options and futures, then you're used to tracking your buying power, and you generally see that you use a certain amount of buying power, whether it's 20, 25, 10, 30, whatever it is. And then you see that excess buying power, the cash and sweep in your Ameritrade accounts on Thinkorswim platform. I'm not sure what it shows up as in other things, but that cash, if you're using 30% of your buying power and it never goes above 40%, then you are consistently not using 60% of the cash in your account. So kind of on a one-man mission to get people to better utilize their excess buying power that is literally just sitting there doing nothing except earning whatever the brokerage company may be paying. And we can look at a little bit of what brokerage firms are paying. I did some research today. So anyway, the Tbill lets you do that. The Tbill holds back 1% of the buying power, and the rest for the Tbill itself, the rest is available for trading purposes. So if you just have, let's say, $100,000 account and or $110,000 account, and you put 100,000 of it into T-bills, you have the other 10,000 to trade with, and you're going to get great buying power relief because they're only holding back 1% of that T-bill. And that is in a margin account. So that's how that works. We're going to bounce on a little bit, and I want to show you all this page. This is another one that's pinned in the room. This is the Treasury itself's page, and this shows the yield curve. The yield curve is the string of rates from 1 month out to 30 years. This specific page, I have it set to show the current month. You just click apply and it gives you the whole month where rates have been in each category for the entire month. You can go back to certain years or forever and scan it. Right now, it's today's rates on the 1 month, which are actually 4 week. I don't know why it says 1 month. These are 4 weeks. When the auction goes off, it's a 4-week treasury, 8 week, etc. We had a 5.17 on the 1 month and a 5.31 on the 3 month. Rates go up until we hit the 6 month. And that's where rates peak at the 5.46 rate. Excuse me, missed a buy number there. They actually peak at the 4 month at 5.49. Then they start going down, 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 down. So this is the high point of the yield curve. This is not normal. Usually these short-term rates are lower and the longer-term securities have a higher rate because of the market dynamics that are going on now. Rates are a little out of place. This is saying that the Fed is trying to slow things down by raising short-term rates, which is basically the Fed funds rate that these things factor off of. And longer term, people are confident that they'll be okay, and with inflation, it'll come down, et cetera, et cetera. I'll stop. I don't want to go too far down that rabbit hole, but this is a great page if you're looking at doing a T-bill or looking at an alternative. You can come here, hit the refresh button, look on today's date. This usually updates around 2:30 Central, and you can see what a T-bill pays. So you'll know, I can earn that in a 1 month T-bill or that in a 2 month T-bill. If you're getting started, that's where you should just stick. And then you can compare it to your other alternatives. Again, the T-bills give you margin relief. These other things don't, but there are pluses to them as well. I'm going to stop for a second and just glance at these questions that have popped up. Charles, I think we'll get into all that in the after session. I don't think those really directly apply here, but we'll get into that shortly. So this is the Treasury yield curve page. It's a great way to figure out what rate you should expect out there in the marketplace. And then the way to buy these, I'm going to start with Ameritrade because that's where my accounts are and that's what I'm most familiar with. Other brokerages are T-bill friendly, some are not. Tasty Trade is not T-bill friendly. I think IB is a secondary market. Interactive Brokers is a secondary market only, but they do have a very competitive secondary market pricing. I reviewed that with someone today, so that was good to see. Ameritrade has a primary, which is the auction market, and a secondary market, which is a market where you can buy not at the auction. Fidelity has a great bond section. It's even better than Ameritrade's. I was checking it out in detail today. And then Schwab, who are all merging, all of us who have Ameritrade accounts will be merging with Schwab in the next few months. I do not have an account with them there, so I don't know how their T-bills work there, but they do have a primary access to the auction as well as a secondary market. So we'll get into it. Let's just do an Ameritrade example. And you guys who've watched Bobby's videos have seen him do this. So he goes into the T-bill section. You can get there a number of ways. So you can go to the trade, fixed income new. I go to, for whatever reason, I usually go to bonds and CDs, and then I go to treasuries, and then I click over on the 0 to 1 year time frame because that's mostly what I'm interested in. And it shows me these are the secondary market rates, and we'll go through that in a minute. Here's the new issues section. You just click on the new issues button. It brings up all the new issues, and then you look for treasury auctions. And then you click view again in the 0 to 1 year category. Just click view. And these show you what is available as far as placing an order. Right now, these little circles indicate what is available. The 4 and the 8 week are available. Today's the 28th. Tomorrow's the 29th. That's when the auction will take place for the 4 and 8 week T-bills. Every week, the auction for the 4 and the 8 week open on Tuesday, and they stay open through Wednesday night into early Thursday morning when they stop. And then the auction takes place Thursday. This is the announcement date, which is the day the orders actually open up for being taken. And then the auction takes place tomorrow, the 29th, and it settles on the following Tuesday. Next Tuesday is the 4th, so these will actually settle on the 5th. So it's a little oddity there. They're different. Any questions with that? Feel free to jump in. I'll try to notice your questions that you type. There are other securities that are, and so we're going to go to a different page now. Again, this is pinned in my room and in the fixed income strategies section. This is the treasurydirect.gov. It's another government site. It shows upcoming auctions. It also shows, upcoming auctions, and it also shows past results. We'll take a quick look at both of those. Here are the 4 and 8 week auctions that we just talked about in Ameritrade. You can see that this is highlighted, so they're live. They're ready to, it's indicating that those are accepting orders. And you can also buy through treasurydirect.gov itself, but this is outside of your brokerage account. So if you want to use this money for buying power purposes, you need to buy within the brokerage account for that. But it's a great resource. This shows you that this Tbill, it's the one we were just talking about. It started being, orders were taken starting on the 27th. They go through to early tomorrow morning. It's best to enter them on a Tuesday or Wednesday instead of toying with the clock on Thursday morning, because I think it shuts down around 7 or 7:15 Eastern. And so that's what's live. It's the one we just talked about. It shows on the circle here. It's live. So this is just another confirmation that this thing is purchasable, buyable, an order can be taken. Starting on, there are other maturities, like here's a 13-week, which is like a 3-month, and a 26-week, which is a 6-month. Those, the auctions take place on Monday. So Monday's the 3rd. They settle whatever the 6th is. I think the 6th is Thursday. And that's how those work. Those are for people who've been doing T-bills for a while and they want to extend their maturities out. We can get into that if you want to. Okay, here's a question. What happens to your money during the week of settlement? Are you earning interest during that week? So you're not, like this is, we'll go to the 4-week. This is the auction that's live right now. So you place your order Tuesday or Wednesday. The auction takes place Thursday and it settles usually on Tuesday, but in this case, it's next Wednesday, the 5th. That's the day you actually start earning your interest. So wherever your money's parked now, probably if it's an Ameritrade, it's earning 0.35%. That's what it's going to continue to earn until it settles. Okay, I want to show you also what happened. These are auction results from the past. So this is last week's auction. The auction, as you can see, it issued on the 27th, which was Tuesday, yesterday, because the auction takes place on Thursday and the bond settles on Tuesday. So this shows that this bond, I'm sorry, not bond, Tbill, matures on this date. I mean, is issued on this date. I apologize. It starts, and that's the date you start earning. So last week's Tbill had a rate of 5.01% and an investment rate of 5.11%. So what are these different rates and what do they mean? Let's take a quick look. So this is and I got to this just in case I did it fast by clicking this or this. The QSIP, just in case you've never seen this before, the QSIP is an electronic identifier. QSIPs have been around for decades. Every stock, every bond, every this, that, or the other has a QSIP. It's not something you and I are always familiar with, but it's like a behind the scenes tag for different things. These treasuries, these are the identifier for these treasuries. Why is it important? I'm going to deviate from this rate for a second, and we'll go back into that. Why is this important? If you're with Tasty, they don't even have a list of what bonds are available. You have to go out and find whatever Tbill you want to purchase and give them the QSIP. And they go out and get a price and they bring it back to you immediately and you decide if you want it or not. It's great to find a source for pricing so you'll have some idea if they're giving you a decent price. I have found them not to be fantastic with pricing, but again, to earn something around 5% is a lot better than, I don't know what Tasty pays. It's probably 0.01 or something. It's probably 0. So anyway, that's what a QSIP is. It's the identifier. You will need to give people like Tasty the QSIP that you want to purchase, and they'll go out and shop for it. Okay, we're going to go back and look at this specific 4-week Tbill from last week that settled on Tuesday. Okay, so here's the sheet on this particular Tbill. So the issue date is, as we said, was June 27th. That was Tuesday. This auction went off last Thursday. It's a 28-day Tbill. Here's the QSIP that we just talked about. When people purchase the Tbills, there's 2 ways to do it. You can do it competitively and non-competitively. We do it non-competitively. We just say we want the Tbill. And whatever the high rate is the rate we automatically get as non-competitive bidders. So it's the 5.01 discount for a 5.11% rate of return. That's like an APY, if you will. So we're non-competitive. There are limits to non-competitive bidding. There's certain dollar limits. So if you're a big, gigantic entity, a bank, wealthy individual, hedge fund, etc., and you want to park some Tbill money, you have to go in and compete against the other big dollar borrowers, or lenders, the people that want to buy the Tbills. And they go in and bid, and they're actually saying, I want to get X amount of Tbill at Y rate. So you can look here and see that the low rate in this particular auction was 4.8%. The high rate was 5.01, and these are discounts. So these are discount rates off of 100. And I'll explain that in a second. So the low rate, someone might have had $1 billion or $2 billion. They're like, I want some of this 28-day Tbill. I'll bid 4.8%. And they are hoping that that rate is low enough. These people have looked over here. They know exactly what the rate is. In fact, they have sources that are ticking their, those giant people, they have quotes streaming on this stuff. So they know exactly what that rate is right when they put this order in. So they know they're giving up some of their yield that they could be based on current market rates, which is this. But they are so anxious or needy to get this money parked that they're willing to accept a lower rate than that 5.17. The lowest rate on this auction was 4.8. The median rate is 4.95. Median, if you recall, is if you have 1,001 things or 1,000 things, the 500th thing is the median. It's the middle number. It's not necessarily the average, but it's the middle number. So rates for this auction went from 480 to 501. The median rate was 4.95. Now, here's the price. The price is the T-bills you buy at a discount and they mature for $100 per 100. So if you bought $1,000 T-bill, which is the minimum at brokerage firms, you would pay $996.10. I'm sorry, you'd pay $100 would be $99.61. And then in the month, it grows to be 100. So you buy it at a discount and then it grows to be 100. So the 5.01 is actually the discount off of 100. It's discounted 5.01% and then it grows into 100. So that compounds at 5.11. A little bit of detail, but I hope that has some validity or meaning to some of you. Okay, any questions on that? All right, I'm going to move on. So we've been through T-bills. For the beginner, you might want to just go with the 4-week and keep it simple on yourself. After a little bit of time, you might want to build out a T-bill ladder where you're buying a 1 month and a 2 month, and you, sorry, I'm getting some pings on the side here. So you buy out a 1 and a 2 month. So every time your 1 month matures, you go out and buy a 2 month. And then your 2 month that you bought a month ago is now a month. So it's a way to squeeze out some extra yield. You buy a 1 month and a 2 month. And then when the 1 month matures, you go back out to 2. And every time one matures, you just go back out to 2, back out to 2. And you can get 15 extra basis points. Is that worth it? I don't know. Not really if you've got a little bit of money. If you have $100,000, it's $150 extra to do it that way, per year. Again, take the multiples up. I've talked to people that have tons of money, and those 15 basis points actually makes thousands of dollars worth of difference a year. So it just varies by account. Obviously, if you have 10 or 15,000, that doesn't really matter. You should just stick with the 1 month. And that's kind of what a T-bill ladder is. I don't want to go into that too much more. Although I did yesterday, I'm going to keep it simple today and not do too much of that, unless someone has a question, in which case I'd be glad to take that plunge. I'm going to move on. I hope I answered all the questions. I said I was going to go back and answer. I want to go on and do a couple of other things. So these are T-bills. They're treasuries. They're direct obligations of the U.S. government. What else can you do with your money to earn some yield? If you're sitting there and you're relying on your broker to pay you some money and they're not really paying you any money, what can you do? So besides T-bills, there are other options. I'm going to go back to the Discord again and find a post. Here we go. So this is in the Treasury Strategies room. I also have it pinned in my room. It's on some alternatives to the T-bills themselves. So these are exchange traded funds, ETFs, kind of like SPY, kind of like GDX, kind of like every other ETF you ever traded. These are ETFs that are made up of treasuries that are of various maturities. So a couple of them that I posted about yesterday are TFLO. It has an average maturity of a little over 1 month. It's all government securities. Tbill SHV and SGov are all short-term as well in the approximately 1 month range. SGov goes from 0 to 3 months, and Tbill is a 3 month only. Xbill is a 6 month only. So if you wanted to buy, I'll just pop back over here for a minute. If you wanted to buy something longer term with a part of your money, and you really don't have great access to the Tbill world, you can say, well, here's the 6 month, it's paying 5.47. It's 30 basis points more than the 1 month. This is a way to do that, to go in and lock in that 6 month maturity rate. Again, for most people's purposes, these shorter term ones are going to be what you want to look at. And these you can buy at any of our brokerage firms, just like an ETF. They trade during the day. They're cost-free to get in and out of, because ETFs are now free to trade for basically, I think, everyone. And let me go over here and show you some of these. So here is Bill, which is the 1 to 3 month ETF. They're sponsored by different people. This is SPDR. I don't know who owns them, but they're various people. BlackRock does some iShares. I think BlackRock is iShares. There are a lot of them. Bill is sponsored by State Street. They own the SPDR brand, if you will. So the way these work is and this is a 1 year chart of this thing. So it goes all the way back to June of 2022. I want to show you basically what these things do over time. Because and don't pay attention to this yield. This is Yahoo's site. Their yields are no good. So just for instance, Bill, we can go look at Bill. Here's Bill on the company's actual website. And we can go to their fact sheet. And this fact sheet is as of March, so it's a couple months old. This is probably more up to date, but this will give you all kinds of information, details on what the fund is made of, the expense ratio, all kind of little things. And the yield at that time was 4.71. The current yield on this thing is, I think it was 4.9 something when I looked earlier. Okay. The 30-day SEC yield is 4.94. So you're earning 4.94 just by buying this thing and holding it in your account with your excess cash. It's not complicated. It's not scary. It's not really even magic. You're just, everyone is unaware for the most part that their unused buying power is basically sitting there, not earning very much. If you're at IB, I have to defend them. They are paying somewhere in the 5% range on their idle cash. They're the exception. Schwab, I talked to today, their automatic sweep vehicle into a bank money market account, which is the default, pays 0.45%. You can set up, I'm going to get into that later, some alternatives in money market accounts. Let me finish this Tbill section. So if you're at if you're at Tasty, or if you're anywhere and you just want to quickly and without a headache of this auction business, either the primary or secondary, we didn't do the secondary. We'll go back into that in a little while. You can just type in BIL, click on the button and buy some. Now the price is $91.73. Don't let that intimidate you. If you have $91.73, you can buy 1 share of this thing and earn the rate of return. So it's just a number. Don't let it intimidate you. And then let me show you how these things actually work. And all these ETFs work the same way, whether it's Bill or SGov, they all accumulate over a month and then pay a distribution. So this goes back to June, July of last year. And rates were lower. So the little bumps, these little bumps were lower last year because rates were considerably lower. The bumps are bigger now because rates are higher now. So there's a bigger drop. But this is not much of a drop. So like here, your NAV was 91.42. that looks like pretty much the low. Look, it was 91.41 here. So in the last year, where rates have gone from like 2 to 5%, this thing has been very steady. And even now, look, the high, the all-time high, which was here in late March, 91.82. And even then, this low was 91.46, which is above and very close to this 91.41. So you can see, despite rates going up, this thing remains relatively stable. Now, what's happening with these spike downs? What happens is, get to a shorter time frame. The thing goes ex-dividend. So if you ever owned a stock that paid a dividend or anything, an ETF or anything else, you know, the dividend builds up, it goes ex-dividend, and that security drops by the amount of the dividend, more or less. And then it starts to build, the dividend builds back up. So this is every month it goes X, every month it drops down, and then it starts climbing a little mountain, earning your return. If you buy here, you've missed this amount of money, but you're earning this amount of money, and it goes ex-dividend. So this came up yesterday. Is it better to wait until it bottoms out and buy it, or is it better to just buy it whenever? The answer really is, how much money do you have to put to work, and how long do you have to wait for it to go ex-dividend? If you've got a lot of money, you don't want to wait 2 or 3 weeks and miss the interest. Go ahead and put it in here, and boom. So, okay, any questions on that? All right, briefly, I want to go real quick into some, and then I'm going to go look at the secondary market because I don't want to forget about that. I want to briefly talk about the taxability of T-bills. So T-bills are taxable on a federal level. They're issued by the federal government. They're taxable on the federal level. The feds and the states have a reciprocal agreement where the states do not tax, the feds do not tax the states on their municipal debt. So when states issue municipal bonds, which are tax-free generally, states, cities, counties, utility systems like sewage, public sewage systems and things like that, all those things can offer municipal bonds to finance projects and operations. They're federally tax-free. The feds do not tax state and local debt interest. And in return, the states don't tax the feds' bond interest either. So these are state tax-free. So this makes them even more appealing if you're in a high income tax state, or even worse, in a high income tax state and in a high income tax city. You can really save quite a bit of income tax by putting your money into treasuries versus a CD. CDs are taxed, or other fixed income is taxed on a federal, state, and local level if you have that local tax. So it's another reason that treasuries kind of shine, in addition to that margining ability of them. Okay, we're going to go into the secondary market here. I'm again going to use Ameritrade because it's what I'm familiar with. Let me just tell you what I did real quick. I'll go back and do it again. So you go into trade, bonds and CDs. We want to look at treasuries. We want to look at the 0 to 1 year. So we click that. This starts now. So this T-bill actually matures in a week. So you could buy that if you wanted to. And then it goes out 1 month, 2 month, yada, yada, yada. Goes out 3 months, 4, 5. There's a lot of stuff here. And then I selected up to 1 year. So it goes out basically to 1 year. So what it's showing me is all treasury securities that they have in inventory that mature in the next month. Larry, great question. I'll get to that in just a second. I appreciate you bringing that up. So the things with zeros are T-bills. T-bills are issued at a discount, so the coupon is 0. These others that have a tiny little yield are actually things that are treasury. They're longer than treasury bills, which are 52 weeks or less. So these are all originally more than 1 year, and anything more than 1 year is either a note, and notes are 1 to 10 years, or a treasury bond, which is more than 10 years. So these are longer term. I don't know how long they were. We could look at it and see, but it's less than a year left of maturity in its life. It matures on July 15th. It originally paid a 0.125% rate. Hard to believe someone would buy that with their money, because that's all it paid. They sold it at 100, it paid 0.125. But that's what these are. They're viable alternatives. If you find one that's paying higher than the zero, you can. They don't generally do that, but you can look for that. So the secondary market is here. This is where you can go if you don't want to wait for the auction. If you want to go ahead and purchase something and not worry with the auction, you can do it here. And the way it's done is you just pull up this, like I said, pull up that area that we went to get to this section, and look for the maturity you want. If you want something that's a month, here's one that's a month out. It's selling at 99.63 per 100. It's yielding 4.89%. 4.89. It's not 5.17. It's 4.89. Even though they both have the same maturity, the secondary market pricing is inferior to the auction. There are a couple of reasons why. One reason is, if this thing just got auctioned a month ago and it's a 1 month treasury, it got auctioned this week, and that's the current one, there's not a lot of it floating. Like, people just bought it. Who's actually selling it? I mean, like, who needs to sell it today? There's not a ton of supply. In addition to that, the brokerages buy these things behind the scenes. So I'm guessing typically the brokerage, our discount brokers, do not actually have these in their inventory, but they have access to these in other people's inventory. So they have to go buy it, and then they mark it up a couple of pennies and they sell it to us. So when they mark it up a little bit, see this 99.66? Let's go look at this one. See, this is the one that, see, this matures July 25th, not the 27th. So there's a little bit of difference. Here's one that matures on the 25th. Oops. Let's look at that one. So, I'm sorry, that's what we were looking at. So 4.89%, not 5.01. Why? Because this is the price they're selling it now, 99.66. Where did it sell at the auction? 99.61. So that 0.05 that they're marking this bond up, this T-bill up to you, makes the rate 99.61. You can buy it now for 99.66. That lowers the rate to basically 4.9%. It's basically 0.12 lower. A lot of detail again, but again, it's just a message that the secondary market is not as optimal as the primary market or the auction. I have definitely looked and cross-compared between Ameritrade, Fidelity, and today I got a chance to do it at IBKR when I was talking with someone else. And Fidelity had better pricing than Ameritrade, and Interactive Broker was about where Ameritrade was, but very competitive as well. Worth doing versus not doing. So there is some variation in the secondary market, and the more you buy, the better your rate is too. For the size we are all doing, for the most part, we are small people in the Tbill world, and we get the privilege of paying a slightly higher price because we don't have the bigger volume going. So that's at Ameritrade. So we've gone through that. Let's see, Larry wanted to know, in an IRA account, let's just go into IRAs in general. So we've just been talking about buying power efficiency in a margin account, a portfolio margin account, in an account that is not an IRA are qualified. It's not a qualified account, which means tax deferred. It's not a 401k. It's not an IRA. It's not a 503c. It's none of that. It's just a regular margin account, or if you have bigger bucks and have applied for it, a portfolio margin account, which just gives you more leverage than a regular margin account. So these qualify, the IRA, the 401k, you can't get the buying power relief no matter what. So it's a slightly different situation, but it's still not a bad situation. So here, I'll show you my account. This is my IRA account. Let me show you what's in it. So right now, and again, for those that you were here yesterday, you already saw this. This used to be my trading account where I was doing my more active futures and that type of thing. I've decided I'm going to turn it into more of a savings account, an investment account. So I'm dollar cost averaging into these 5 mutual funds weekly on a very slow dollar cost averaging program that I just started a few months ago. And I basically took the account balance and divided it by 18. Actually, I divided it by a year and a half, which is 52 plus 26 is 78 weeks. And every week I go in and purchase that amount. So I'm at the end of the period, I'll have slowly deployed all this money, the 74,000, into these mutual funds. In the meantime, what am I doing? And we'll look at this. So right now what I'm doing, and you can't see it here, but I'm doing a little bit of 111 in this account. I actually have 1 naked put, and I think 2 put debit spreads on in this account at the moment. So I do a little bit of 111 in here, and then I have these T-bills. So this is my little T-bill ladder. I have some that mature on the 20th of July. I have some that matures on August 10th and some that matures on October 26th. And again, this is just a little attempt by me to earn a little bit higher return by going out a little further on money that I know I'm not going to need, because this money is not needed for my dollar cost averaging program until months from now when I've gone through all this money and then this money. And then, you know, it's parked for a reason, and I'm earning the rate I'm earning in the meantime. So it's just 45,000. I'm earning probably 4.7 on it. All these have been purchased for a little while now, maybe a little higher on this one. So it's a lot better than zero. And let's see what this cash here is actually not in a T-bill. It's not in futures margin. It's not in the ETFs. It's just sitting there. It's here because I'm trading a little bit of 111. I'm about to put another one on. I need some of that anyway, so that's why I have it here. But let's look at what Ameritrade is so generously paying us in their sweep account. Okay, this is their core account, 0.35. When I started doing this a year ago, it was 0.01. So they've raised it, but like, do you want to earn 0.35 or do you want to earn something closer to 5%? So that's the gist of what we're doing. And to zero in on Larry's question about margin and all this in a qualified account, this is taking up buying power. It's actually using 45,000 of the 75-ish thousand in buying power. But I don't really care because I'm still earning whatever I'm earning on these. And if I need this money, if I do a 1-1x tomorrow and I do another one 2 weeks from now, and then the market has a huge pullback, I may need to liquidate some of this. I may need some extra buying power. I can go in and liquidate one of these very easily. I'll show you how in just a second. So the bottom line is on all qualified accounts, IRAs, whatever you have, 401k, et cetera, you don't get any buying power relief from a T-bill at all. So you can do a T-bill, you can do a T-bill alternative, like we mentioned, this bill thing or any of these others. It's all the same because they're all using up your buying power when you do it. But again, Most of us are trading under the metrics of what we trade, which means somewhere in the 10 to 50% buying power is where most of us sit on any given day. And the excess above that, even in the most levered accounts that are 50+%, they still have 40 to 50% of their account value in cash, probably earning something like this. They really should do themselves a favor and take at least, if you're throttling at 50%, maybe you want to leave 15 or 20% of your buying power available in immediate cash, and who cares about the rate? You're levered up pretty good there. You're probably generating a good return if you can keep it under control. So it's not a bad thing to just leave some cash in that situation, but even then you're still losing out on 35% of your account value that could be earning this 5% yield. So again, it's something to consider, and just do the math and you'll see if it's worth doing on your account. Larry, does that pretty much answer your question on the marginability? So bottom line is all those words. It doesn't matter if you do T-bills. It doesn't matter if you do the ETFs like we talked about over here. It doesn't matter, and there are others. This is just a short list, but these are some good ones that I've kind of looked at and they look good to me. It doesn't really matter what we're doing with our money in a qualified account because it is sucking up the buying power, but you basically just ignore these. So when you're doing your metrics, I ignore these ETFs. I ignore the T-bills, and I just look at what my 11X is generating for buying power purposes and compare it to my cash and see if I feel good with it.
Ed,
that all makes sense.
Ed, let me give you
now
an
I want
example.
To go into, was that good? Any more questions before I bounce to something else?
Yeah, Ed, let me ask one more thing. Can you hear me?
Okay. The next thing I want to look at are actual money market accounts. So money market accounts, unlike these T-bills, which we've seen can move around a little bit in price after you buy them. They move around because they're appreciating. They move around because interest rates are changing. And unlike the T-bill ETFs, which go up and down and up and down and up and down, albeit in a short compressed range, it's not much at all on percentage terms. The money market account is designed to keep a $1 net asset value. So you put $1 in, it's worth $1. It doesn't deviate from the dollar. And that kind of is what basically defines a money market account. So here is Fidelity's government money fund. It's got an NAV of $1. During the financial crisis of 2008, the Reserve Fund, which was the biggest money market fund at the time, because of the stress and the marketplace, actually lost its $1 net asset value, and I think went to 98 cents. And of course, people were freaking out about all that. These things are not supposed to break it's called breaking the buck. It's not supposed to happen. Oh, thank you. Okay. Did someone have a question? Stefan, did you have a question?
It was Larry. Can you hear me now?
Yeah, I apologize. My speaker.
Larry was talking earlier.
Yeah.
Yeah, Ed, can you hear me now?
I can. Thank you.
If you don't mind, let me go back and make sure I'm clear on the IRA situation. Let me just kind of give you an example.
Sure.
Right now, I'm probably 25% buying power usage and somewhere around 60% in T-bills.
Okay.
What I guess my question is, if I have a downturn in that, the BP usage gets above the common, well, let me ask it this way. The combination of T-bills and BP usage can go up to 100%. Once it goes over 100%, I'm going to have to liquidate some T-bills. Is that correct?
Yeah. Yes, so if you're in an IRA and I forgot what you said your buying power is. What's your buying power?
Well, somewhere
Generally.
around 25%.
Okay, so let's just make up numbers. You're at 25%.
And about 60, right now I'm about 60% in T-bills
Okay,
in
so
that account.
let's pretend your account is $100,000. So 60%, 60,000 or 60% is in T-bills, and 25% is in buying power reserves for your positions.
Yep.
And you have 15% free. So that means, according to that math, you have a $15,000 cushion for buying power expansion. Is that basically what you're seeing?
Yeah, now walk me through. Let's make that example. I'm at 85,000 in T-bills or 75,000 in T-bills and 25%
Yeah,
BP usage.
yep.
And tomorrow I got a downturn in the market. My BP usage is at 30%. So I'm in 5% deficit. I don't
So
know how.
you need to go in and sell $5,000 worth of your T-bills to alleviate your margin.
Okay.
You've gotten a
So
margin.
that's really the only thing that if I'm levering up pretty heavy on trying to have all that excess cash in T-bills, the only thing I'm doing is running the possibility of having to liquidate early if I
Exactly.
overextend
And we
it.
can go, it's really not a big deal. We should
Yeah.
cover and we will cover that. We can do it now. So basically you've created a margin call, but you've done it because you've jammed your account with so much T-bills that you're kind of flirting with having a margin call because so much of your account is dedicated to T-bills. It's not a bad thing. All you have to do is, and I've had to do it once, I had to go in and liquidate, I think it was either 12, and I think I liquidated 15. You basically, you get the notice. And if you're at Ameritrade, you see your cash and sweep number. Let me see what I got for Ameritrade up here. Okay, well, I'm not going to take the privacy mode off, but here in the cash and sweep, it's a positive number. Are y'all seeing my account here? Are you
Yes.
seeing my platform? Okay, great. So your cash and sweep number is normally positive. When you have a margin call, it goes negative. So that's your big hint. Oops, I got a margin call. I need to go liquidate something. So let's show how you do that. You go in. Now you have to trade the T-bills through the website. It doesn't work through the platform. So you log in, you go to my account, you look at your positions. And then I generally look at the shortest maturity because that's the one that's going to be closest to 100 per 100. And so here's a $15,000 T-bill. It matures on July 20th. It's worth $14,954. So I only have $45 and change left to earn on this thing in the next month. So if I need to sell some of it or all of it, you just basically click right here on the symbol, which is the QSIP. You go in and you tell it how much you want to sell. So we had 15,000. If we want to, and these are priced in thousands. So if you want to sell 15,000, you just type in 15. If you want to sell 5,000 because you only need 3,000 or 4,000 to cover your margin, or you have a $1,000 margin call, whatever, you type in. You don't have to sell the whole piece. You can sell whatever you want. You click this. It says calculate total cost. It gives you a price, 99.73. which is giving the person buying it a 4.8% yield. And that's the money you're going to get. 15, whatever you sell, if it's 5,000 is what I chose to sell here. So 5,000, that's 50 hundreds. So 50 times 99, 733. This is what I'm going to get right here. And then you just click, it's giving you the price. Now you would just click sell. And it goes into a pending order. queue, which I can't really show you right now, but when you click send or buy or sell, it sends you to a page. You've seen it in Bobby's room where it's like a pending order page. And these things basically sell. Usually when I've done it, I've only done it twice. You just hit refresh and it's boom, it's done. It's very instantaneous. And then just as instantaneous, you look back at your platform and in the cash and sweep number, that amount of money has been immediately placed in here and your margin call is alleviated. So I like to tell people, don't worry about the liquidity in these is insane. I mean, it's just absolute top of the top. So you don't have to worry about liquidity. They're very sellable with your own click. You don't have to talk to anyone. Again, you just go into your positions page, pick the one you want to sell, click on the CUSIP, type in how much you want to sell in thousands, get a price, like the price, hit the sell button. It happens that quickly. So this is the least risky button click that you'll ever do in the trading world. So don't be intimidated by it. I know a lot of people are very intimidated by all this. It's kind of like doing your first option trade because it's something you've never done before. You don't want to click the wrong button. You don't exactly know what you're doing, yada, yada. This is a very, 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 very low risk situation. There's really almost not, I mean, I guess you could do a fat finger mistake, and I think there's things prohibiting you from buying more than is in your account anyway. I saw that today at IBKR. I bet they're all like that. So there's just not a lot to mess up here. And there's not a lot to understand either. Larry, you bring up the perfect point in that when your cash and sweep goes negative, that's the amount of your margin call. You log into your account, you find your security, you click the CUSIP, you sell the amount you need, and boom, your margin call is alleviated. You go on with your business. So the T-bill is not your problem. Your problem is what created your margin call. That's what you need to be really concerned with dealing with. So I hope that kind of speaks to people on the risk of that. Now, we talked yesterday a little bit about what is the risk of buying these if interest rates move. So like the Fed is projected to hike rates at the July meeting. So let's look at this. This is the Fed funds rate going back to 1955, and you can see what it's done during expansion periods. These little highlighted periods are recessions that have happened. And what's happened then, this is the big rate explosion of 1980 into 82, when inflation in the 70s just wouldn't stop. It was mostly an oil driven and then a price spiral higher. Paul Volcker came in as Fed chair. He raised the hell out of interest rates. You see the Fed funds rate went all the way up here to 20%. Yes, there were government securities longer term in the 15, 16% range. You could buy a 30-year treasury at the time for 15, 16%. CDs, everything was paying out the wazoo. And that broke the back of inflation. And then inflation's basically been in a down spiral since 1980. And you can see that rates have just basically been in a down move since that 1980 inflation scare. Since the Great Recession of 2008, when rates went from like basically where they are now to zero, and say squish down to zero for basically, here's 2017 into 2018. If any of you were trading options in 2018 and the market was great and then it collapsed at the end of the year, this is why the Fed attempted to raise rates off of zero. They got them up here near 2%, above, almost at 3%. The market freaked, it collapsed, and the Fed chickened out and they raised rate. They started lowering rates again. They lowered them here. This is COVID. Here comes COVID. They took rates from this 1.5, 1.6 area, probably 1.5 to 1 3/4, smashed it down to zero again, left it down. So we've come through an extended period of 0% interest rates in the world. And that's one reason nobody understands or knows about these T-bill type things and how they actually work. So there's a little history on the Fed funds rate. Here's a little CME group tool. If you watch CNBC or Bloomberg and you hear them saying, oh, the percentage chance of a rate hike is blah, 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 blah. That's a conglomeration of a lot of bets in the bond market on what people think rates are going to do and what the Fed's going to do. Right now, there's a 79.4% chance that the Fed's going to raise rates from 5 to 5.25 to 5.25 to 5.5 at the July meeting. So it's great certainty. It's not 100% certain, but it's very certain. You know, it's a very high percentage. So chances, and look, it goes out to different time periods. You can look in different times and see what the market is pricing in for what the Fed is going to do in the Fed funds market. Kind of interesting. So odds are very strong for a rate hike in July. And they've been talking it up. Powell's been talking for a couple of weeks now, since the last FOMC meeting. And then this week, again, he was talking yesterday and today. He is continuing to say he expects another rate hike or two. Central banks around the world are raising rates right now. Canada just raised their rate last week. I think there was no rate hike expected, and they raised it. Great Britain raised theirs 0.5%, and the market was expecting 1/4. And Christine Lagarde, the head of the EU, the European Central Bank, has been saying they plan on raising rates more. The central banks around the world are in a coordinated effort to raise rates and break inflation. Why is it so important? Because if you don't break inflation, like in the 70s, inflation was roaring, and they raised rates and they kind of stopped raising rates quicker, and inflation roared back, and then they had to raise rates way higher, create a whole nother big old recession. 1982 was a big giant recession, one of the bigger ones up until 2008. The width of this thing is the length of the recession, by the way. So, and again, in my opinion, these were oil price shocks, where oil went from like $1 a barrel to 10 or 12, and then it shot up to 20, and then it shot up to 40. And then it collapsed way back down again. And then we all know what's happened to oil. I won't go into details there, but the Fed needs to keep rates high and make sure inflation is squashed down, because if they don't really squash it down, it's just going to come back, and they're going to eventually have to take rates higher. So that's what they're toying with now. That's what looks like they're wringing their hands over. How much do we have to raise rates? How long do we have to leave them higher to kill inflation, but hopefully not wipe out the economy? Okay, I'll get off of that horse. Any other questions for me in that area?
Yeah, I've got a question, Stefan, here. So this Fed funds rate, the chart you're showing right now, this is the overnight interest rate, right?
The overnight rate right now is 5 to 5.25.
Right.
It's actually a range. And you can see that on this other chart.
Right. Okay, so say the Fed raises by 1/4 point.
Yep.
The overnight rate, how does that affect these T-bills if we're
Okay, great question, Stefan. Really good question. So the only rate that the Fed really affects is the Fed funds rate. That's the rate they set. They literally pick the rate they want. Everything else is keyed off of what they do and market perception of what will be. And what I mean by that is, right now, the 1 month, if you buy the 1 month today, right now, and it settles, you get the auction tomorrow, and it settles Tuesday, you're going to get around 5.17. That's higher than the Fed funds rate, which is 5 to 5.25. That's the market saying, we think the Fed's going to raise rates at the July meeting by 1/4, and they're pricing some of that rate hike in. They're not giving you 5%. They're giving you, and they're not giving you 5.25. They don't know for sure. If they knew for sure they were going to hike, of course, it's the meeting's in what, 2 weeks, I think. We can look at that in a minute too. part of this rate is a market perception that the Fed is going to raise rates again, and people want to be paid for the second half of July where the rate's going to be higher. So they're kind of demanding a higher rate. This is the marketplace saying, we believe that the Fed's going to raise rates. And so going out here, the further out you go, we could almost look at the Fed funds rate as like the splash rate, like the rate that they control. It's like a rock falling in a pond, and all this other stuff ripples off of that based on market perception. What is market perception? In the short-term stuff, 2, 3, 4, 5, 6 months, even out to a year, it's what's the Fed going to do and how long are they going to keep rates high? The rest of these, more or less, in my opinion, are longer type rates, even 2 years. You're saying, well, 2 years, not 30-year. No, but 2 years a lot longer than a month. So when you get out here beyond a year, the market starts thinking, where's inflation going to be? And how long is the Fed going to keep rates higher? So the longer we go out now, maturity-wise, you can see where rates start topping out and coming down, because the market, which is the masses of millions of people and institutions every day buying and selling this stuff, pricing the supply and demand, they're pricing these yields in, which basically says, for a year, we think a 5.32 rate is going to basically cover you for inflation and whatever else the Fed may do. That tells me, this rate right here, a year, kind of tells me that the market thinks there's another rate hike in the Fed, and it's going to hang up there for a while. This rate tells me pretty much for about a year, they think the Fed's going to keep rates up, minus a little bit. Like there may be a slight cut, but the market is not really factoring in a lot of cut, in my opinion, in the next 6 months to a year based on what I see in this interest rate. Now, can that perception change? Yes, and it has changed. For any of you that have noticed, rates went up over the last 3 weeks. They've been trending higher for the most part. There has been some panic in here from time to time, like during the March thing. But like here, we can look back at June 1st, and the 1-year rate was at 5.11. Now it's at 5.32. So it's up 20 basis points, 1/5%, almost 1/4%, just this month. That's the market pricing in the Fed jawboning that they're going to start raising rates. A month and a half ago, everyone was saying, oh, rates are going to get cut by August. We're at the height. They're done, yada, yada. In the last few weeks, that thought process has changed. So the rate has gone up in almost every situation. If you look at the 2-month, it's down a little speck, 5.39 to 5.32. The 1 month itself has gone from 5.3 down to 5.17, a little weird. If you all recall, and we can look at it, let's look at it, because this is interesting. Let's look at what happened. So this goes back to January. In January, the 1-month T-bill was at 4.17, the 1 year was at 4.72. Now we went from 4.17 to 5.17, and the 1 year is at 5.32. It was at 4.72. So about 60 basis points, a full percentage point on the 1 month. So this, let me show you this. So this is rates leading into the Silicon Valley Bank blow up. So rates were kind of trending higher and higher, and then all of a sudden, boom, they start dropping and dropping and dropping. So they go from 483 on March 9th down to 4% on March 21st. That's a pretty good big cut. Why was that happening? Because money was flooding out of the banks. You kept hearing about all the money flowing out of banks. Money flowed out of banks and into what? Into these treasuries. That's what it flowed into. And that was where these competitive and non-competitive bid things come in. We're non-competitive. We just say we want to participate. The big money flowing out of the banks that had to park somewhere are competitively bidding, and that drove rates down. Then as the banking crisis subsided toward the end of March, rates started bouncing up a little bit, up a little bit, up a little bit, up a little bit. And then you can see, look how much they went up. Now here you had another little, I don't know what caused this. I'm guessing, was there a scare in the market around April? I don't know. Something drove rates down a little bit right there for about a week. And then they started popping up again. And now they've been trending much higher throughout the month of May. This is when the debt default stuff started getting priced in. And look, May 3rd, the rate was 4.7. May 4th, up a whole percentage point. This is when the market started freaking out about the government not extending the debt limit. So they were demanding higher rates. Remember, the June 1st was the deadline, we kept being told. So anyone who bought on March 11th was buying in something that matures around June 11th, which could be 11 days into the default. They want extra rate. The risk was there that they might have to wait a little. I always said it might be days or a week or two. They're not going to default for long because they just can't afford it. There'd be too much chaos. But this was the market saying, we want more rate because we have fear that the government may default for a short period, and we want to get compensated for it. And you can see as we go into May, look, it popped above 6% here on May 26th. Look what happened over the weekend. This was Memorial Day weekend when the Yahoos came out and, quote, settled it, unquote. Look at the rate plunge from 602 to 531. This is all market perception, market fear, market worry about the government defaulting, what's inflation going to do, what's the Fed going to do, all these things mixed together. Then as the default thing faded away, rates started going back down a little, and they've kind of just hung there. So a lot of words. There's a great example. The Silicon Valley Bank thing affected short-term rates. And so did the prospect of the government defaulting on its debt, another rate moving factor. Those things are behind us now. Now we just have to wonder, how long is inflation going to stay high? How long is the Fed going to need to leave rates higher to kill off more inflation? And how long can the economy stand these higher rates before it starts to crack and slip into a recession, which is what everyone has more or less been worrying about. Less so lately, because in the last week or so, the jibber jabber that I pick up is mostly people talking about the fact that we're not going to slip into a recession, or not as likely. And rates may have to stay higher for longer and may have to go higher, period. So a lot of words to answer that. There are so many factors that factor into what makes rates do what they do. It's really hard for me to summarize in a short conversation, if at all. But just know there's a lot of different psychological things going on in this rate setting mechanism beyond what the Fed does, which really, even in the shortest term, we saw two examples in the first 6 months that jolted these rates up and down just by market forces. Now, those are two unusual things. We don't usually have bank issues like we did then, and we don't usually have this government default thing, although we've had both of those situations in the past. So they're two examples. Again, we're more or less settling down into now the tug of war between the Fed and where they have rates, where they may take them, and whether that will send the US economy and other economies into a recession type situation. That's the bulk of what affects rates, in my opinion. It's inflation expectations in the longer run. In the shorter run, it's all these other factors. I hope that kind of explains it, Stefan. So I give you a big enough earful.
Yeah, great. Thanks.
Sure, I'd be glad to elaborate more, but that's probably more than enough. Let's pop into, so we covered T-bills, we covered the exchange traded funds. I want to go through a couple of money market funds. We started looking at these. I got distracted. I'm going to go back to this. And a typical money market account, they're taxable, they're not taxable. They're made up of government securities only. They may be made up of governments and corporate bonds. They may be made up of US government and foreign government, but there's all kind of different money markets. Money markets are not all created equally. I like to focus on the government money market funds because everything I want in my money market fund, I want it to be a government-backed thing, a government-backed security. And here's a list of what's in this fund. Treasury bills, that's a year and less. Treasury coupons, those are things that they're calling coupons. Those are notes and bonds. Anything that has a coupon attached, you buy it for par. It pays you a stated rate of return. That's the rate you earn. Strips are longer term zero coupon treasuries. You buy them at a discount. They pay no return between the purchase time and the maturity time, just like a T-bill, but these are longer term, years, and sometimes decades long. And it's weird, back in the day when these first came out, rates were much higher, and you could buy a treasury strip that might be 30 years out, and you could buy it for, say, $10,000, and it might mature for $60,000 30 years from now. You could actually buy one and plan out cash flow for your own future decades ahead. Rates are so pathetically low right now. You know, going back to this, who the hell wants to lock up 10 years at 3.7? I mean, I don't, unless I hit the lottery, in which case I won't care and it'll be fine. So back here, money market accounts are made up of all kinds of different things. For our purposes, I personally recommend the government securities ones that have all these direct government-backed things. These agency things, what's an agency? Fannie Mae, Freddie Mac, Federal Home Loan Bank, all kind of different governmental entities that issue debt. That's what agencies are. They are backed by the government, so they can fit in here. Some government onlys are only T-bills or repurchase agreements. These repurchase agreements, what's a repurchase agreement? I'm really going down rabbit holes here, but a repurchase agreement is where someone owns the T-bill and they want to loan it to someone to get some cash. So they loan it to someone who gives them the cash. So this fund buys the repo. It's buying it and giving the cash. It doesn't own a T-bill. It holds an agreement that is secured by a T-bill. It's basically a T-bill. But it is interesting because I'm sure some of you are scratching your head saying, what in the heck is this guy talking about? I want to stop for a second and just tell you the T-bill is a direct government obligation. The government money market account is not. So this is Fidelity's government money market fund. No one is really backing this up. Fidelity is working hard to keep it at $1. All these money market funds generally do that, but there's no one backing this up. So the safety of this money market fund actually comes from what it's holding underneath the hood, so to speak. It's very, very safe. It's not as safe as the Treasury bill directly, because the Treasury bill directly is the government's obligation. This is not the government's obligation. This is Fidelity's obligation, and it holds government securities in this. And these are all segregated things. They don't just take all this money and plop it into their general account. They segregate the money out. So this requirement is to do that. Okay, I'm going to back out of that rabbit hole and explain more of what our choices are for our money market accounts. So those of us at Ameritrade, we get things like this. That pay us things like this. So Fidelity, oops, logged out, but you remember it was a 0.35%. Tasty, I don't know what they pay on their cash, but it's probably 0.01. They're not the type of firm that's advertising what they're doing. For rates, they're not trying to draw customers in with their rate on cash balance. They have other tools for drawing their customers in. So not good choices there for these money market accounts. But those of us at Ameritrade are going to merge with Schwab. Schwab has a couple of different money market accounts. So I'm going to go into Schwab first, because that's where all of us Ameritraders are going to go shortly. And Schwab's default sweep account sweeps your money into, and a sweep account is like your cash and reserve account. It's loose cash in your account. brokerages automatically sweep, quote unquote, sweep that money into some type of parking vehicle. In the case of Ameritrade, it's that 0.35 money market account that you just saw. They probably have another option or two. You may have a different one in your account, but they're all paying pathetically low rates. Schwab has a default money market account that's paying 0.45. And then they have other options, 3 government options. And there's another one. People have been talking about SWVSX. That is actually a money market account that holds things that aren't just US government debt. And so I'm not personally super thrilled with that one. It pays 4.93 as of this afternoon. Their treasury only fund, which is this one, SNSXX, as of this afternoon pays a 4.81% rate that compounds at a 4.94%. So it pays a higher rate and it's safer in this case. But even if it weren't safer, I'm not looking at making a fraction of a percent. I'm looking at making 5% instead of 0.3. I don't care if I make 4.9 instead of 5% and put my money at risk into corporates or foreign governments or anything else. Are those risky? Not in a normal world, but if you're holding that and the government defaults on its debt and the whole world is affected by that, we don't know what the ultimate outcome of that is. So this is not money you want to take a chance with. Stick with your treasury only type money market funds that have government only securities in them. So this SNSXX is a sweep vehicle at Schwab, but it's not their default sweep vehicle. You have to ask for it. So you have to call them and say, hey, I want to make SNSXX my default sweep vehicle. So in that case, this account I showed you up here where I have this 18,000 sitting here in this pathetic account earning 0.35. When this moves to Schwab, I'm going to direct them to put this money into this fund. It'll earn the 4.9 or whatever it's paying then based on rates. If rates go higher, the rate will go higher. If rates start falling, it'll fall as well. So this is a great automatic choice at Schwab. Fidelity has this one. It pays 4.75. It's also a government only. It automatically sweeps your money in. So that's a great option. These are like no-brainer, you can sleep through it options. If you don't want to mess with the T-bill, the primary, the secondary, you don't even want to mess with ETFs, you don't like buying something that's $91 and having it wiggle up and down 20 or 30 or 40 cents every month, go into the money market account. You don't get margin relief for the money market account. But again, I'm going to use Larry's example, our hypothetical example of Larry with his $100,000 account. He's got 60,000 or 60% of his buying power in T-bills. He's getting margin relief. Unless it's in the IRA, then he's not getting margin relief. In that case, since you're not getting margin relief, you can just have this be your default vehicle. This, if you're at Fidelity. If you're at Schwab shortly, you can make this your default vehicle. Don't mess with the BIL or the SGov or anything else. Just go with this. It automatically puts your money in. So Larry's hypothetical 60K would automatically be earning the 4.9 whatever percent it was, or 4, I think, without Larry doing anything. Does he get margin relief? No, but he doesn't get it from the T-bill either. So he's basically giving up 0.15, 0.2%. But his money is conveniently moving in and out of an interest-bearing account as he needs it or doesn't need it for his buying power. So you're giving up a little tiny bit of return for a pretty good amount of convenience. And if you don't need the buying power anyway, it doesn't really matter. So it's not as great as the T-bill as far as the buying power thing, but it's a really close second. It pays you a great competitive return. It's made up of very safe things, et cetera. So, as an interim, if you're in a brokerage account that offers a treasury money market fund, call them, talk to them, ask them what the 7-day yield is. There might be a 30-day SEC yield. Some of them, there are different ways that these things are quoted. This one has fun characteristics. Look, the average life is 45 days. So the average life of the security in this account is 45 days long. So it's short-term T-bills. Okay, do these pay state tax? My experience with these treasury money market funds is they tax you based on what is in the fund. So if you get a treasury only money market fund, then you are going to avoid paying state income tax on that because of what's under the hood. But if you go with Schwab's generic fund, which has different things in it, SWVSX, you'll get a tax bill that's going to break out your money market account interest by different categories, and it'll be taxed differently. That's my experience in the past. I'm a former broker. I'm a former brokerage manager. I have a deep financial services history in many other areas. You can go check me out in my first video. I think I went into some of my background there. So I'm just kind of qualifying that I'm not a CPA. I'm not a tax professional. All the information I'm giving is my best knowledge, but I'm pretty sure it's accurate. Okay. What else can we talk about? I think I'm at the end of what I wanted to cover tonight. Does anyone have any questions that they want to present to me here? If not, I'll turn the mic off and we can go into a live session and get into that. Give anyone a few seconds to either type or raise their hand. Okay, well, thank you for attending. I appreciate it. I'll see you all around in the Discord, and I appreciate your participation. Have a great evening. Hope you enjoyed it.